If you look closely at what happened in 2025, there's a signal here that would make any serious person about money stop. Silver exploded, not because the world got richer, but because the system got more fragile. And this type of movement has appeared before major disruptions. I'm not making a dramatic prediction. I'm simply observing patterns that repeat throughout history, like a doctor recognizing symptoms he's seen before. If you understand how markets work, supply, demand, psychology, and politics, then you understand that certain signals come before major changes. Silver is one of those signals, not because it's magical, but because it reflects something much deeper. When economic fundamentals are under stress, certain assets begin to behave in ways that tell us a story about what's coming. And this story we've heard before. In October 2025, silver reached levels we hadn't seen in almost half a century. But that wasn't all. What really catches attention is how it got there and what was happening around the world when it occurred. At the same time, China signaled export restrictions starting January 2026. Global inventories are being drained rapidly. The market is facing its fifth consecutive structural deficit. If you've seen this pattern before, you know the kind of pressure it creates. History is an excellent teacher, especially when it comes to economic cycles. Let me show you 3 moments when the same pattern appeared. In 1971, it was cheap. In 1980, it became a different world, and it wasn't about the metal. It was about confidence. President Nixon had ended the convertibility of the dollar to gold. Inflation was skyrocketing. People were losing confidence in the monetary system. And silver, it was reflecting that loss of confidence. The Hunt brothers became famous for trying to monopolize the silver market at that time, but that's only part of the story. The truth is that major investors realized something that few people understood. When you print money without backing, real assets become more valuable. Fast forward to 2008. The global financial crisis hits. Silver was trading at about $9 per ounce. What happened next? The Federal Reserve lowered interest rates to 0, introduced quantitative easing, expanded the balance sheet on a historic scale to stabilize the banking system. And silver, it rose to nearly $50 per ounce in 2011. Again, it's no coincidence. When you distort the monetary system through extreme policies, assets like silver become a relief valve when money loses reference. Now we're living through the third moment. Silver surged in 2025. It reached levels we hadn't seen in decades. And the conditions surrounding this rise are remarkably similar to the 2 previous periods. We have growing geopolitical tensions, extreme monetary policies that continue, massive fiscal deficits, and for the first time in decades, a serious question about the dollar's role as the world's reserve currency. The difference this time is that we're not just dealing with a national monetary crisis, we're dealing with a transition in the global world order. China is consolidating its control over critical commodities. Russia is being forced out of the Western financial system, and countries around the world are questioning whether they want to continue depending on the American dollar. In this context, silver isn't just an asset. It's a thermometer of international system stability. To understand why silver is reacting this way, you need to remember some fundamental principles about how the economy works. First, everything in the economy is cyclical. There are 3 types of cycles that drive all economic activity. Productivity cycles, which last decades and are based on technological innovation. Short-term debt cycles, which last 5 to 8 years and are controlled by central banks. And long-term debt cycles, which last 50 to 75 years and determine the fate of currencies and empires. We're at the end of a long-term debt cycle. This means that the tools that worked over the past decades to manage the economy are reaching their limits. Silver is a dual asset. Unlike gold, which is primarily a monetary asset, silver has 2 personalities. Industrial, where more than 50% of demand comes from industrial uses, being essential for solar panels, electric vehicles, electronics, and AI data centers, and monetary, where it has historically served as real money, especially in times of monetary uncertainty. When these 2 demands align, as is happening now, you have a situation of extreme supply pressure. If you understand incentives, you understand behavior. What's China's incentive to restrict silver exports? Strategic control over a critical commodity during a time of growing geopolitical tension. What's the incentive for investors to buy silver when it's accelerating like this in a year? Fear of missing out combined with legitimate concerns about monetary stability. What's the incentive for governments to keep printing money? Avoid short-term political collapse, even if it creates bigger long-term problems. In a normal free market, when price rises, supply increases and demand decreases until a new equilibrium is found. But we're not in a normal free market. Silver supply is limited because 70% of production is a byproduct of mining other metals. Even if the silver price doubles, miners can't simply decide to produce more silver if it's not economically viable for the copper or zinc they're extracting. On the demand side, you have governments around the world implementing green energy policies that require massive amounts of silver. You have the exponential growth of artificial intelligence that demands more data centers, which demand more silver, and you have growing demand for assets that preserve value during periods of monetary instability. Markets don't react to what's happening now. They anticipate what will happen in the future. Silver isn't rising because the economy is collapsing today. It's rising because market participants are anticipating a future where supply will be even more restricted and demand will be even higher. It's not a prediction. It's a logical consequence of forces already in motion. Let me give some concrete examples of how these principles manifest in the real world. Inventories at major exchanges and custody centers have fallen sharply in recent years. And in some markets, physical silver has started to disappear. If you consume more than you produce for long enough, eventually inventory becomes the bottleneck. And when it becomes a bottleneck, price does the rest. That's exactly what's happening with silver on a global scale. In Asia, physical metal started trading at strong premiums, while in the West, the paper market lagged behind. This is the market's way of saying real metal is getting rare. This tells us something important. There's a growing difference between the price of silver on paper and the price of real silver. When this difference grows, it's a signal that the price discovery system is starting to break down. People are willing to pay more for physical silver because they don't trust that paper contracts will be honored with physical delivery. This only happens when confidence in the delivery system begins to deteriorate. Starting January 2026, only state-approved Chinese companies with annual capacity of at least 80 tons will be able to export silver. This effectively cuts off hundreds of small and medium exporters who have served global industrial clients. Imagine if a country that produces 30% of a critical resource suddenly said, we're only going to export through 5 government-controlled companies. What would happen to the price of that resource in the rest of the world? Exactly what's happening with silver. Demand for solar panels is reaching global records, but the amount of silver used in each panel is falling because of high prices. It's like an industry growing rapidly while trying to use less of a critical component at the same time. Eventually, you reach the physical limits of how much efficiency you can extract. Silver-based ETFs receive huge inflows in 2025, but here's the interesting part. Many large investors are converting their ETF positions to direct physical allocation. This means they no longer want exposure to the silver price. They want the physical silver in their hands. When institutional investors start worrying about physical delivery, it's a signal that they anticipate problems in the financial system. Now let's talk about what this really means for people like you. If you're close to retirement or already retired, you probably have most of your wealth in stocks and bonds. Historically, this has been a sensible strategy. But we're at a moment in history where systemic risks are growing. Silver surging in a single year isn't a missed opportunity you should regret. It's an alarm signal about the stability of the system in which you have your savings. It's not a prediction, it's an observation. When assets like silver move this way, it usually means other parts of the financial system are under stress. If you have 20, 30, or 40 years until retirement, you have an advantage, time. But you also have a challenge. You're going to live through a transition in the world economic order. The international monetary system that has existed since 1971 is reaching the end of its useful life cycle. This doesn't mean the world will end, but it means the rules of the game will change. Silver is signaling this change because it's sensitive to both industrial and monetary factors. Inflation isn't just about food or gas prices rising. Real inflation, the kind that really hurts your long-term purchasing power, is what happens when governments print money to finance spending they can't pay for in other ways. When an asset like this accelerates in a single year, it's partially a response to anticipation that this type of inflation is coming. Real financial security doesn't come from having a lot of money. It comes from having assets that will maintain value regardless of what happens to the monetary system. Silver is behaving like these assets behave when major changes are coming. It doesn't mean you should invest all your savings in silver. It means you should be aware that we're in a period of transition and plan accordingly. If you have a business, especially one that depends on commodities or international trade, you need to understand that we're entering an era of greater volatility and uncertainty. Silver is an early indicator of these conditions because it's used in so many industrial processes. When commodity prices become volatile, this eventually translates into higher costs and tighter profit margins across the economy. Based on the principles we've discussed and the historical patterns we've observed, here are some practical guidelines for navigating this period. I'm not saying to abandon stocks and bonds. I'm saying not to put 100% of your wealth in assets that depend on the perfect functioning of the current financial system. A balanced portfolio in times of transition includes productive assets like solid company stocks, traditional monetary assets like government bonds, real assets like commodities and real estate, and alternative monetary assets like precious metals. The exact percentage depends on your individual situation, but the principle is clear. Don't put all your eggs in one basket. In periods of uncertainty, it's better to have fewer high-quality assets than many questionable quality assets. For stocks, companies with solid balance sheets, little debt, and essential products or services. For real estate, properties in fundamentally solid, non-speculative locations. For precious metals, physical products, not complicated derivatives. You need enough cash to cover emergencies and opportunities. But holding too much cash during a period of possible monetary instability is like holding ice during a period of extreme heat. A sensible balance is 6 to 12 months of expenses in cash, plus a strategic reserve in assets that can be easily converted to cash if needed. The most important thing you can do is understand how economic cycles work. Not to become a speculator, but to not be caught off guard when things change. History, basic economics, and the principles of how money and credit work are time investments that pay dividends for life. Transitions in the world economic order don't happen in months or years. They happen over decades. Silver could fall 50% next year and still be signaling the same long-term trends. The important thing isn't to try to time short-term movements. It's to position yourself appropriately for long-term realities. When systems are in transition, volatility increases across all asset classes. This doesn't mean panic. It means psychological and financial preparation for periods where your investments may fluctuate more than you're used to. Volatility is the price we pay for long-term returns during periods of change. Nobody, including me, can predict exactly how these transitions will unfold or when. What we can do is observe patterns, understand principles, and position ourselves so we can prosper regardless of which specific scenario materializes. Intellectual humility is essential during periods of uncertainty. Silver isn't rising because it's special or magical. It's rising because it's reflecting fundamental forces that are reorganizing the world economic order. These forces are the transition from American dominance to a multipolar world, the transition from a debt-based monetary system to something not yet determined, the transition from an industrial economy to a digital economy, and the transition from abundant resources to scarce resources. Each of these transitions by itself would be significant. All happening at the same time create a period of historic change. Silver is telling us this story because it's sensitive to all these forces simultaneously. But here's the most important part. These aren't the first transitions in human history, and they won't be the last. Every generation faces periods where old rules stop working and new rules need to be created. Those who understand this and prepare adequately don't just survive these transitions, they thrive. Those who assume the future will be like the recent past are often caught unprepared. The choice is yours. History teaches us that the deepest changes are often signaled by movements of the most basic and fundamental assets. Gold told us the story of the end of Bretton Woods. Silver is telling us the story of the end of the system that came after. It's not a catastrophe. It's a transformation. And transformations, while challenging, also create the greatest opportunities for those who are prepared to navigate change instead of resisting it. If you look carefully at the patterns we've discussed today, you'll see that silver isn't just rising in price. It's teaching us a timeless lesson about how human societies adapt when old systems reach their natural limits. The question isn't whether this adaptation will happen. The question is how you'll position yourself to be part of the solution instead of a victim of the problem. Silver isn't trying to make you rich, it's trying to warn you that the world you knew is changing faster than it seems. In economic cycles, price screams before the news.